What was your read of this hotter than expected inflation report, specifically when you break down services where we saw hospitality, airfares come in a bit higher than expected?
Well, it wasn't surprising to me, and it's because of the factors you're mentioning. I mean, we travel a lot. We have client meetings, and hotels are sold out, planes are sold out. The pricing is through the roof, and the wages that the workers at these organizations are earning are higher than the Fed's target. So if you have higher costs for the providers, higher demand from consumers, higher prices is the natural result, and people should not be surprised. We also looked in that report at the higher oil prices, higher energy prices. Even if the Fed tries to take oil out of their numbers and their data crunching, oil is a part of other component parts throughout this cycle, throughout the economic chain. So we are not surprised that inflation is stubborn, and we expect it to remain so.
What does this mean for investors then if this does raise the possibility of another interest rate hike in November?
Well, we think investors are savvy to consider that as a possibility, but I don't think we need to panic. I think we are nearing the end of a rate hike cycle. I just think we're going to be higher for longer. I think the Fed's going to have to gently back off this 2% target and live with something between 2 and 3%. And bond yields will steady and level out, and stocks can do well in that environment. They have in the past. I don't think we have to push a panic button just because the Fed's not going to be cutting rates in the near future.
All right, so don't hit the panic button, but what does this mean for banks, which have underperformed so far this year? We've seen profits being hit by higher interest rates. If we are, in fact, going to be living in this environment of higher for longer, how does that affect their path to growth and profitability going forward?
Well, that's a great question because banks are in a real conundrum here. They are at a major cost disadvantage with the growing online deposit gathering machines of the online banks. So then they have to compete at a detriment to their bottom line. But what's almost worse is what's called the internal disintermediation, where their deposits, which were at 0 and 1%, are now being forced to reprice at 4 and 5% as consumers come in their branches or call online and ask for the competitive rate. That crushes their net interest margin. Their top line is being compressed, all while an economy is slowing, and you may have credit problems. And if you have credit losses combined with a lower gross margin on the deposit side, this is going to cause problems for their profits. Their only way out, as we see it right now in the near term, is a massive merger wave, which is long overdue. That will help with costs, and that will help them be more competitive in a very competitive financial services space.